Forget everything you've heard about moving averages. 99% of traders use them wrong, and it's killing their accounts. In this video, I'm going to show you exactly how I win consistently using a moving average trading strategy. Here's the exact path you're taking today. We'll start with the most profitable pullback patterns. Then I'll reveal why the slope matters more than price. We'll talk fakeouts. This one trick saved me from hundreds of losing trades. Some of these strategies might surprise you, especially when you see the power of displaced and adaptive moving averages. So by the end, you'll have a complete moving average trading strategy system that actually works. Here's where 90% of traders mess up a moving average strategy completely. They chase breakouts instead of waiting for the pullback. Most people see price break above the 50-period moving average, for instance, and buy immediately. Bad move. I learned this after losing so much money doing exactly that mistake. Watch what happens when you wait for the first pullback after a breakout instead. Price breaks above your moving average. Everyone gets excited. Price shoots up 10 or 20 pips. Then it happens, the pullback. Price comes back down to kiss that moving average. That's your entry. Here's how you implement this. Set your 50-period exponential moving average on your chart. Wait for a clean break above it with strong volume. Don't chase. Let price pull back to the moving average. When it touches and shows signs of bouncing, that's your signal. Look at my screen here. See how price broke above the moving average. Everyone bought there. Price went up fast, then pulled back. That pullback to the moving average was my entry. Made easy 30 pips on that trade. It's a simple mindset switch. You're not chasing breakouts anymore. You're waiting for the market to come to you. Now, what I'm about to show you about slope literally changed how I see every chart. Most traders look at moving averages as static lines, but they miss the most important part, the angle. The slope tells you if momentum is building or dying. When the moving average points up sharply, momentum is strong. When it flattens, momentum weakens. Here's the secret. Steep slope equals strong trades. Flat slope equals weak trades. I avoid trades when the moving average slope is flat, because flat slopes mean sideways markets, and sideways markets chop you up. Look at your chart right now. Draw a line along your moving average. Is it pointing up aggressively? That's acceleration, good for long trades. Is it starting to flatten? That's deceleration, time to be careful. I use a simple rule. If I can't see a clear angle on the moving average, I don't trade. This saved me from countless losing trades in choppy markets. Here's how you implement this. Before every trade, check your moving average slope. If the steep is up, look for longs. If the steep is down, look for shorts. If it's flat, you stay out. This simple check improves win rates dramatically. The slope is telling you the story of momentum before price even moves. 99% of people use moving averages based on the close price. I prefer to use a moving average channel based on high and low price. You see, traders get this wrong by treating the average like a single line in the sand. But price often moves above or below that line before reversing. A high-low channel can give you a margin of safety. Price rarely goes straight up or down after a breakout. It moves in waves around the moving average. Here's the pattern. In an uptrend, price pushes above the moving average channel, pulls back to it, then pushes higher again. Each high gets a bit higher. Each low comes back to the moving average. Watch what happens when you start seeing this channel. Instead of random price movement, you see structure. If price is above the channel, you have a bullish bias, with opportunities to go long at the top of the channel. Below the channel means a bearish bias. You look for shorts at the bottom of the channel. Take a look at this. The moving average channel acts like a magnet, pulling price back when it gets too far away. The moving average channel in combination with price position makes the next concept even more powerful. Now here's where most traders completely mess up a moving average trading strategy. Many assume that if price touches the moving average and bounces once, it will bounce forever. That's not always true. Fakeouts happen when price momentarily breaks below or above the average, luring you in, then flips course again. The market tricks you into thinking the trend changed, then it snaps back like a rubber band. I personally fell for this trap hundreds of times. Price would break below my moving average, I'd sell, then it would rocket back up above the moving average. Frustrating and expensive. The secret is recognizing fake-out patterns. Real breaks have volume and momentum behind them. Fake breaks look weak and hesitant. Real breaks hold a new level. Fake breaks fail quickly. Here's my fake-out filter. When price breaks a moving average, I wait 15 minutes. If it can't stay on the new side with volume, it's probably fake. If it creeps back above the moving average within those 15 minutes, I ignore the break. Watch closely here. See how price dipped below the moving average around the market open. But no volume, weak momentum. Within 10 minutes, it was back above the moving average. This is a classic fake out. Also check the slope again. If the slope is still firmly in your favor, that quick breach might be noise. Watch what happens when you see a big candle that closes under the average, but the slope is still pointing up. Many times that move reverses swiftly. Here's how you implement this. Never trade immediately on moving average breaks. Wait for confirmation. Watch volume. Watch momentum. Watch the slope. Let the market prove the break is real. And here's the best part. Failed fakeouts often create the strongest moves in the opposite direction. When that fake breakdown fails, the bounce can be explosive. Most people have never heard of this. A displaced moving average is the same line, but shifted to the right on your chart. This changes how you view price relative to that average. If you shift it forward, you might catch turning points a bit earlier because the line doesn't clutter the present bar. You see, standard moving averages lag behind price. They tell you what happened, not what's happening now. Displaced moving averages solve this problem by shifting the line forward in time. This creates something magical. The moving average appears to predict where price wants to go. It's not really predicting, it's showing you where price would be if the current trend continues. Here's where it gets crazy. Price often respects these displaced moving averages. The market seems to know where these future levels sit. In this chart, I use a 50-period EMA, displaced forward by 10 periods. This gives me support and resistance levels that most traders can't see. Look at that line ahead of current price. That's my displaced moving average. Most traders had no idea that level existed. Here's how you implement this. Take your favorite moving average. Shift it forward by 10 or 20 candles, depending on your time frame. For example, a 20-period MA gets shifted forward 10 periods. Now you have future support and resistance levels. Okay, here's where it gets controversial. Moving average crossovers are probably the worst moving average trading strategy ever created. Everyone uses crossovers. That's exactly the problem. When everyone uses the same strategy, it stops working. The classic crossover setup goes like this. A fast moving average crosses above a slow one, so you buy. Sounds simple and works terribly. Crossovers fail because they're too late. By the time the fast line crosses the slow line, the move is often over. You end up buying tops and selling bottoms. I tried to make this work. I tested hundreds of combinations. Win rate was always under 20%. Average losing trade was bigger than average winning trade. Mathematical disaster. Here's the brutal truth about crossovers. They work in trending markets, but kill you in choppy markets. And the problem is, markets chop 70% of the time. Look at your chart right now. Count the crossovers from last week. How many actually led to profitable moves? Probably less than half. Instead of crossovers, focus on price action around single moving averages. Much more reliable, much better timing. Here's what you should do instead. Use one moving average as your trend filter. Trade pullbacks to it in trending markets. Ignore crossover signals completely. The best traders I know stopped using crossovers years ago. This next part about bounce patterns was a huge light bulb for me. If you only remember one thing, let it be this. Price loves to revisit a certain moving average and bounce off it in a strong trend. Maybe it's the 20 EMA if the trend is hot, or the 50 SMA if it's slower. Those bounces can be safer entries than chasing breakouts. The key is reading the signs before the bounce happens. Strong trends create reliable bounces. You see it all the time. Price pulls back to the moving average, finds support, then continues the trend. This happens because the moving average acts like a magnet for price. I look for three things in bounce patterns. First, strong trend before the pullback. Second, clean approach to the moving average. Third, signs of buying interest as price reaches the moving average. Here's my favorite bounce setup. Price trends up strongly, pulls back to the 50-period EMA, shows a pin bar or an engulfing candle at the moving average. Next candle breaks above it. That's my entry. Watch what happens when you start seeing these patterns. Instead of random bounces, you see predictable setups. Look at this market. See how price bounced perfectly off the EMA 3 times. Each bounce led to perfect moves. This is what consistent profits look like. Here's how you implement this. In uptrends, watch for pullbacks to your moving average. Identify if the slope is solid. Look for reversal candles at the moving average. Enter on the break of the reversal candle high. The opposite works for downtrends. Price bounces down from the moving average after pullbacks. You might ask, how do I pick which average to watch for the bounce? That depends on the personality of the market. Some markets respect shorter lines, like the 20 EMA. Others might use the 50 EMA. You need to experiment and backtest. There's no magical average that will work on all markets. Once you find a line that price respects, that bounce pattern can be gold. This part can be a game changer if used correctly. You'll be surprised how simple a moving average ribbon can be. A ribbon is a set of averages for different periods, spaced out. Picture a colorful band on your screen. If all lines are stacked in order, from shortest to longest, that often signals a strong trend. If they flatten, the trend might be weak. So a ribbon is multiple moving averages plotted together. Instead of one line, you have between 8 to 12 lines of different periods. When they align, they create powerful trend signals. They help you see the market structure at a glance. Think of it like this. One moving average can lie, 2 can be coincidence. But when 8, 10 moving averages all point the same direction, the trend is real. The ribbon works like a traffic light. Green when all averages point up and stay separated. Red when they point down and stay separated. Here's the secret most traders miss. The space between the ribbon lines tells you trend strength. Wide spaces mean strong trends. Narrow spaces mean weak trends. Tangled lines mean no trend. For starters, you can use a 12 ribbon system. Periods from 5 to 50. When they fan out nicely, trade with the trend. When they tangle up, stay out. The bigger the separation among the lines, the stronger the momentum. If you see them pinch together, that can mean a slowdown. I used to ignore these. I thought one average was enough. But then I realized that a ribbon can give me early warnings about trend changes. If the fastest average starts to roll over and crosses beneath the next line, that's the first sign. If the rest follow, that's even clearer. And the slope of the entire ribbon can reveal if the market is accelerating or not. The ribbon eliminates a lot of bad trades because it keeps you out of choppy markets. Clean ribbon means clean trends. Messy ribbon means messy markets. This filter will improve your trade selection dramatically. Speaking of filters, let me show you something that works even better. 99% of traders have never heard of envelopes, but they're game changers for moving average traders. Envelopes are bands drawn above and below a moving average, usually 2 to 3% above and below. They create channels that contain most price movement. When price hits the upper envelope, it often reverses down. When it hits the lower envelope, it often reverses up. The moving average in the middle acts as the balance point. So envelopes expand or contract based on a percentage or volatility measure around a single moving average. This helps you see potential overbought or oversold conditions in real time. And this is exactly why envelopes work better than other indicators. They adapt to market volatility automatically. In quiet markets, the bands are tight. In volatile markets, they expand. Envelopes work most of the time because they move with the market. The beauty of envelopes is mean reversion. Price rarely stays at extreme levels long. It wants to return to the average. The envelopes show you where extreme levels are. Take a look at this. See how price bounced perfectly between the envelope bands. Upper band rejections led to profitable shorts. Lower band bounces led to profitable longs. Now, don't think envelopes are only for sideways markets. Actually, a trending market can also ride the upper envelope band. If you see price clinging to the top band, that might signal strong momentum. If price wanders inside the envelope, momentum may be fading. Here's how you implement this. Set a percentage offset around your 20 or 50 moving average, maybe 2% or 3%. Watch how price interacts with those boundaries. When price hits the upper envelope, look for short setups. When it hits the lower envelope, look for long setups. This concept gets even more powerful when we add volume. If you only look at price, you might miss a piece of the puzzle. You see, regular moving averages treat every price point equally. A big volume day has the same weight as low volume day. This creates problems because volume shows institutional interest. Volume-weighted moving averages solve this by giving more weight to high volume periods. When institutions trade heavily, those prices get more influence on the average. Think of it like voting. Regular moving averages give everyone one vote. Volume-weighted averages give bigger traders more votes. Since bigger traders move markets, this makes sense. The volume-weighted average reacts faster to price changes when volume is high. It reacts slower when volume is low. This creates more accurate support and resistance levels. Here's where it gets interesting. Price often respects volume-weighted average levels better than regular moving averages, because these are lines where the real money changed hands. I started using volume-weighted lines for scalping after noticing my regular EMAs were giving too many false signals. The volume-weighted lines kept me in good trades longer and got me out of bad trades faster. Watch closely here. Compare a regular 20-period average with a 20-period volume-weighted average. Observe how the volume line hugs price action better. The volume-weighted line works especially well during breakouts. That's because breakouts need volume to sustain. Now here's where most traders completely mess up their moving average strategies. They only look at one time frame. That's a missed opportunity. If you track a daily average and then an intraday average, you can align your trades with the bigger trend. If the higher time frame average is bullish, but your lower time frame average turns bearish, maybe you only take short-term quick trades or skip the short side entirely. The daily chart average shows the big picture trend. The 1-hour chart shows entry timing. When all time frames align, trades work better. When they conflict, you will struggle. This is why you need multiple time frame analysis. Here's my time frame system. Daily chart for trend direction, 1-hour chart for entry timing. Both must agree before I risk money. I use a 10-period simple moving average on daily and 20-period on the hourly one. You might say, I don't want to juggle multiple charts, but it's worth it. Last week I took a long trade on the hourly chart, not realizing the daily average was sloping downward. That daily line crushed my trade. Here's how you do it. Check a lower period average on a higher time frame. Price above it. Is it sloping up? That means the long-term trend might be strong. Now see a higher period average on a lower chart. If that's also bullish, that's more confirmation. And never trade when time frames disagree. This filter alone will improve your win rate by 20 to 30%. Now, most traders think moving averages are only for trend following. Not really. They're equally powerful for mean reversion in the right conditions. Mean reversion means price returns to average after extreme moves. When price gets too far from a moving average, it usually snaps back like a rubber band. You'll be surprised how simple this reversion plan can be. It might be dangerous if the trend is super strong, but in a range or mild trend, a reversion can bring quick profits. I used to ignore reversion trades. Then I realized that markets rarely move in a straight line. Even in a robust uptrend, price might get overheaded and revert to the line. If you see that price is extremely distant from the average, that can be a short-term fade opportunity. Just watch for slope. If slope is steeply up, it might be risky to fade. But if slope is gentle or flat, a reversion trade can work. The key is identifying when price has moved too far. I use a simple rule. If price is more than 3% away from the 200-period EMA, it's extended. Extended price often reverts quickly. I enter only if I see a divergence at the top or bottom of the channel, or if I see a trendline breakout. That are my confirmation filters. Look at this trade. Observe how price gapped down 4% below the 200 EMA. That long trade was a good candidate for reversion setup. Price was back at the EMA by the next day. Easy 100 pip profit. So here's how you implement this. Use envelopes or another reversion channel. When price moves more than 3% away from your moving average, look for reversion trades back to the average. Enter on the first sign of reversal after a divergence or a trendline breakout, and simply target the moving average. Now, very important, most traders pick a fixed period. For example, they use a 50-period average no matter the conditions. An adaptive moving average adjusts its calculation based on market volatility or price behavior. That helps you respond better if conditions shift from quiet to wild. You see, regular moving averages never adjust to market conditions. Adaptive moving averages change their sensitivity based on market volatility. When markets are trending strongly, adaptive moving averages speed up to follow the trend closely. When markets turn choppy, they slow down to filter out noise. Think of it like cruise control that adjusts to road conditions. The most popular adaptive moving average is the Kaufman one. It uses an efficiency ratio to determine how much to adapt. High efficiency means trending market. Low efficiency means choppy market. The result is a line that's dynamic, not static. It might hug price closer when things get crazy and drift away when things settle. Here's why this matters for your moving average strategy. Fixed period moving averages give false signals in changing conditions, but adaptive moving averages adjust automatically. I discovered Kaufman adaptive moving average a few years ago after getting whipsawed repeatedly during market transitions. My regular EMAs kept giving false signals. The backtest showed that the adaptive average stayed smooth and reliable. Compare the regular 20 EMA with a 20-period adaptive average during trends and choppy period. See how the adaptive average speeds up to follow the trend closely. Then it slows down to filter out noise. And a bonus tip, the adaptive average works especially well during news events and during the market open when volatility changes rapidly. Most people miss this completely, but moving average clusters create the strongest support and resistance levels you'll ever see. A cluster happens when multiple moving averages converge at the same price level. Instead of one moving average, you have 2 or 3 lines all sitting together. If you see the 20, 50, and 100 averages all near the same price, that can be a magnet for the market. Price might stall there, bounce, or break with force. Here's why clusters work so well. Each moving average represents a different group of traders. The 20 period represents short-term traders. The 50 period represents medium-term traders. And the 200 period represents long-term traders. When all these groups agree on a price level, that level becomes incredibly important. Bounces are sharp. Breakouts are violent. No middle ground. I hunt for clusters every morning before the market opens. They show me exactly where the big moves will happen that day. Check this out. Observe how the 20, 50, and 100 period averages all converged around this area. Well, price bounced over 100 pips off that cluster level. The plan is simple. If price bounces off a cluster, trade the bounce direction. If price breaks through a cluster with volume, trade the breakout direction. You now have many angles to refine your own moving average trading strategy. Use each chapter's insights in a way that fits you. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.